Stop panicking about the dip. This could be your golden ticket to the next Bitcoin all-time high. And it's all happening faster than most people realize. In the next few minutes, I'll show you the exact market signal that has flipped every major crypto cycle before, and how timing this move could be the difference between just surviving and multiplying your stack. What we're seeing right now is a real shift in market sentiment. For the first time in recorded financial history, every major developed country is watching long-term bond yields surge. Even as their economies show clear signs of weakness, the old playbook, well, it's broken, folks. And most investors have no idea what's unfolding right under their noses. And if you miss this, you'll watch your purchasing power melt away, while those who are positioned early and correctly will ride the next transfer of wealth for generations to come. The tariff wars between the US and China, the same ones that rattled global markets not too long ago, are threatening to come roaring back. Japan's central bank, one of the safest players on the planet, lost nearly $200 billion on bonds in a single year. America's biggest companies, well, they're suffering the sharpest profit drop since the last crisis. And at the same time, crypto is seeing a wave of momentum unlike anything we've seen before. Completely, definitely unlike anything I've seen in my 13 years in the space. Billions are pouring into crypto funds. Real money is moving faster than anything we've seen in previous cycles. Bitcoin's legendary golden cross is playing out right now. A technical setup that's launched monster rallies in past cycles. And everywhere you look, new records are being set. ETF inflows, market highs, and extreme volatility that has even wiped the biggest whales completely out. Be careful with leverage, folks. Be careful with leverage. But underneath all these headlines, something bigger is shifting. The very rules that underpin global finance. Are we looking at the start of a financial meltdown or the single best chance in years to grab generational upside? Ladies and gentlemen, don't blink, because today I'm breaking down the numbers nobody's connecting and the playbook that could drastically change your immediate future. So stay with me, step back, and you can see how fast this environment is shifting. This spring, US-China tensions ramped up in ways we haven't seen in years. The US government hit a record with $16 billion in tariffs in just 1 month, while imports fell by almost $20 billion, the sharpest monthly collapse on record. For everyday people, that means the gears of global trade are grinding slower, and the cost of everything from raw materials to finished goods is rising. Meanwhile, Treasury Secretary Bitget is calling out China for holding back critical rare earth minerals, straining supply chains even more. Wall Street's not immune. Despite the S&P 500 booking its best monthly gain since 2023, there's a nervous energy underneath that everyone can sense. The cost to insure against US government default is back near decade highs. A reminder that risk is rising even as markets try to celebrate new all-time highs. But here's what should make every investor sit up. The US 30-year Treasury yield just surged above 5%, levels we haven't seen since 2007. Back then, the economy was booming, and today, US GDP just contracted for the first time in years, with negative 0.3% growth last quarter. The story is the same across the world. Germany's 30-year bonds hit 3.10%, a level not seen since the global financial crisis, even as their market growth was slashed to 0.3%. The UK's 30-year yield, 5.4%, the highest since 1998. In Japan, once the poster child for stability, just hit a 25-year high on the 30-year yields. And their own prime minister admitted their fiscal situation is now worse than Greece during the European debt crisis. That's nuts. And as these shockwaves hit, global liquidity is in motion. Japanese institutions are adjusting their treasury exposure, just like we saw with their central banks. And the effects are making it harder for risk assets, including crypto, to find their footing. If you want to understand why markets feel so jumpy, look at Japan. The Bank of Japan's bond portfolio is sitting on the biggest losses in its history. And every tiny move in domestic yields now adds tens of billions more to the pain. When institutions in Tokyo start rethinking their US Treasury exposure, the signal ricochets worldwide. US rates tick higher, the dollar tightens, and suddenly borrowing costs everywhere start to climb. History backs this up. Whenever the yen breaks down, Japanese traders pile into Bitcoin. During the 2023 slide toward 150 yen per dollar, Bitcoin's shares of trading on Japanese exchanges shot from roughly 70% to 80%, and monthly turnover topped $4 billion. Then, when the currency cracked 160 last April, Bitflyer recorded a 15% jump in the BTC Japanese yen trading pairs almost overnight. And just days after the BOJ's most recent bond market shock, 24-hour BTC and JPY volume spiked another 15% week on week. But here's what's different about this cycle. It's not just Japan this time. We're seeing a synchronized spike in yields across the US, Germany, UK, and Australia, all during a period of economic stagnation. That's never happened before. The market is sending a clear signal that something is off at the foundation of money itself, far outside the patterns of a typical business cycle. Each time yields rise and the yen buckles, local money rotates into Bitcoin, searching for a store of value the traditional systems can't dilute away. It's a vivid example of how a policy move in Tokyo can set off a chain reaction in Wall Street and the crypto charts. That's why liquidity stress in Japan is a metric every serious investor should watch. Switch gears, and you're looking at a global chessboard where every move is designed to gain leverage. In May, the US hiked steel tariffs to levels not seen in decades, drawing immediate condemnation and potential countermeasures from Europe, China, and to make things worse, it's weaponizing its control of rare earth exports, a move that's got supply chain managers scrambling on both sides of the Pacific. This is a major escalation in economic tensions. In real terms, we've seen US imports plummet and corporate profits fall at a pace not seen since the C-19 crash in 2020. Back then, supply chains froze and demand evaporated overnight. Now we're seeing similar numbers, but this time, it's coming from policy decisions. These numbers triggered a strong reaction across the markets, setting up a whole new phase of turbulence. We're going to see more wild price swings, companies turning cautious and cutting back on big decisions, and more investors actively searching for assets like Bitcoin that can rise above all the political drama. Remember, Bitcoin is apolitical. It doesn't belong to any nation state or actor. It's global, and that's why we love it. When you combine all of this with the historic moves we're seeing in the bond markets, you get a cocktail for risk that's never been poured before. No wonder the conversation about digital gold and new forms of financial sovereignty keep getting louder as these trade disputes escalate. Amid all of this, the most important moves might be happening in the deepest pools of money, US government debt. Jamie Dimon has warned, if America keeps piling onto its $36.3 trillion debt and global buyers step back, something's gotta give. For the first time in 25 years, the UK now owns about $860 billion in treasuries, roughly 85 billion more than China. That nudges borrowing costs even higher. The 10-year treasury yield has already touched 4.55%, and the latest 10-year auction drew the weakest demand in a year and a half. What that means is, when demand for US debt dries up, it costs more for America to borrow. So rates go up, stocks get shaky, and every mortgage, loan, or credit card gets more expensive for regular people. Wall Street isn't cheap either. Today's investors are paying $21 for every $1 of next year's S&P 500 earnings, well above the long-term average of about 16. Looking at an even longer time frame, a popular valuation gauge called the Shiller CAPE sits around 32. That's basically a big picture price to earnings ratio that smooths out profits over the past decade. So you can see spot bubbles and crashes before they happen. Right now, it's at a level that historically shows up right before major pullbacks. That means today's stock prices leave very little margin for error. If earnings disappoint or the economy stumbles, there's a much bigger risk that these high prices could fall, especially with bond markets flashing warning signs. That stress shows up in the cost to insure US debt. One-year credit default swaps are at 52 basis points, almost as high as the 2023 debt ceiling scare. Bond desks are already pricing in a future where governments focus on weakening their currencies as a way to address economic challenges, rather than aiming for real growth. This goes way beyond spreadsheets and economic theory. There's signals that traditional safe havens are being questioned, and assets with limited supply, like Bitcoin, are set to benefit big time if these cracks start to widen. All of this uncertainty is making itself felt in the crypto markets. Institutional money continues to flood into Bitcoin funds. $6.5 billion went into BlackRock's Bybit in May alone, with 31 out of 32 days posting inflows. Yet, as May closed, $430 million rushed back out in a single day as whales booked profits and fresh retail money stepped in. On the Ethereum side, Arthur Hayes is calling for a possible doubling of price by year's end, though even he admits the road will be choppy, especially as Wintermute is flagging that the Pectra upgrade is being hijacked by scammers, who are using it to drain wallets faster than ever. And if you needed even more proof of late cycle volatility, just look at James Wynn, the on-chain whale who controlled roughly $2 billion in highly leveraged positions. Last week, those positions were margin called into oblivion, erasing nearly his entire stack in hours and triggering one of the largest single force liquidations of the cycle. Classic shakeout energy as we near a turning point. But here's what cuts through the noise. In just 1 week, crypto funds saw $3.3 billion in net inflows, the second highest of the year since 2019. Total inflows are now over $63 billion, with assets doubling in just the last year. Even as headlines warn of fear, real money keeps moving into the space. That's the kind of capital momentum that historically sets up the biggest moves. Altcoins, meanwhile, are still lagging. Most alt BTC pairs are stuck below resistance, with new lows across the board. Not good for our bags. Tech devs' market cycle charts suggest we may be near the end of the altcoin bear market and the start of a historic expansion. But as always, only the patient get to enjoy the full cycle when it finally turns. But before we get into the technical side, there's one more hidden signal flashing in the Bitcoin market right now that could impact everything you're seeing on the charts. As of May 30th, 2025, there's a hidden signal flashing in the Bitcoin market that most people are missing. It's called the CME Annualized Basis Trade. This measures the extra yield that big funds can earn by running a carry trade that's buying spot Bitcoin, often through ETFs, and shorting Bitcoin futures on CME. As long as the yield stays high, institutions have a strong incentive to keep buying Bitcoin spot ETFs. About 3 months ago, I dropped a deep dive breaking down how this carry trade was steering Bitcoin's price. I'll put a link in the description below if you guys haven't seen that. It's really interesting to watch. You can actually have a little crystal ball if you guys can watch this stuff close enough. And if you were watching last Friday, I also flagged the CME basis trade as a critical signal we're tracking in real time. At the time, the premium was sitting around 9.6%. Just 2 days later, it slipped to 8%. And I said if it broke below 7%, it was time to pay close attention. Well, here's what's changed. Since it's now down to 6.57%. That's the lowest we've seen in months, and it's a signal you do not want to ignore. Why is this important? Because once yields fall below 7%, a lot of hedge funds start questioning if the trade is worth the effort. When you add in fees and costs, the profits start disappearing. And if the basis keeps falling, these funds often unwind their carry trade, which means selling their ETF shares and closing out their future shorts. What could happen next? We could start seeing ETF outflows, large redemptions as hedge funds exit the trade. And I think that we're already seeing that. Let me show you something. What we've got here is Arkham Intelligence measuring the BlackRock ETF custody in and out. You can see starting 8 hours ago, this is where we started, negative 300 Bitcoin, selling Bitcoin, 300, 300, 300, 300, 300, 212, 300, 300, all sells of Bitcoin. This is literally the trade unfolding. This is what you're watching in real time. That trade started to wind up, and now it's unwinding. I'll show you something else very interesting here. Again, 300, 300, about $420 million worth of Bitcoin outs in the BlackRock ETFs today. What's really interesting is you won't see that yet when you go into something like Farsight and look at these charts here, right? The data for today is not in yet. And you can see this is the carry trade unwinding. So far, it's been almost $1 billion of unwind. And we see that again today, almost another $420 million flowing out from BlackRock today. So 430 million last week, on Friday, and there's going to be about 420 million outflows today. But what I think we should be paying attention to right now is Ethereum. Look how they've seen inflows. And today, again, if we take a peek and we look at BlackRock, you can also see while they sold 420 million worth of Bitcoin today, they also bought about $70 million worth of ETH. So the question is this a time with the new rules that were enforced that we talked about last week, where now the Ethereum ETH ETFs will start allowing staking rewards to generate passive yield on that asset? That's attractive to asset managers like Vanguard, who didn't even play the spot Bitcoin and ETF game before. Now they might be doing the Ethereum and Bitcoin spot ETFs. So yes, this unwinding can put pressure on Bitcoin's price, or at least create short-term volatility. In the past, when the basis fell under 5%, more inflows are likely to come. It's a pretty easy indicator to see at least how the hedge funds are playing it. Right now, the safe money, or these kind of delta neutral strategies, are either picking short-term treasuries, which are earning about 4.25%, or they need to clear at least 5.5% for it to be worth their time and effort and fees on this carry trade. So once that drops down to below 6%, it doesn't make sense. They unwind, they go back to treasuries. It's a pretty easy indicator and it works really well. It's not the only one that we should be looking at, but it is a kind of cheat code for you guys to keep checking out. That's why I encourage you to go watch those Velo charts. So right now is not the time to panic, but it is a smart money signal that often moves ahead of headlines. And there's so much tailwinds right now. I don't know if this is going to be a huge unwinding because it didn't last for so long, right? So the longer it lasts, the bigger it gets, the more effect it has on the price, both up and down. So as of May 30th, the yield that powered a major Bitcoin ETF trade is now starting to run low. If this trend keeps going, it could be an early warning for more turbulence in both the ETF market and Bitcoin's price. We'll keep tracking this for you and let you know if the signal turns critical or if it turns upwards. I'll be watching this stuff daily. Bottom line, watch these institutional flows and carry trade signals closely. But remember, smart money always plays both the numbers and the narrative. Now let's break down what the technicals are saying and why the golden cross could flip the script for Bitcoin in the weeks ahead. On May 20th, Bitcoin's 50-day moving average officially closed above the 200-day moving average, confirming the golden cross for this cycle. If you're new to technicals, that just means that Bitcoin's recent momentum has turned so strong, the short-term trend is finally moving above the long-term trend. This golden cross has been a classic setup for bull markets in the past. The reaction was quick. Within days, Bitcoin shot to new all-time highs near $112,000 on May 27th, then cooled off to around $105,700 by June 1st. If you guys are following me on X, at Kyle_CHASSE, you probably caught the post that hit nearly 1 million views. I flagged the golden cross dump before it happened. A lot of you messaged me after saying you locked in profits or nailed the shot perfectly. Congratulations. And is it going to fall to my target range of 102,000? I don't know. We'll see. I don't have a crystal ball, but it just historically what has happened tends to happen again, and it looks like it's playing out right now. But right now, both moving averages are still rising, and the price is holding above the 50-day at about $104,000 and the 200-day near the $102,000. Most chart analysts say the golden cross stays valid as long as we don't see a daily close below that $102,000 zone. It's worth noting that we've already seen an initial shakeout, about an 8% retracement from those all-time highs. So far, that's been the market's way of keeping late buyers honest. But historically, these pullbacks can go a bit deeper before the next move up. So what actually happens after a golden cross? Here's what history shows. Almost every time, Bitcoin pulls back hard right after the signal, usually dropping 10 to 15%. Sometimes that dip hits within a few days, like in 2015 or 20. Other times, Bitcoin keeps running for a month or two before it finally cools off, like we saw in 2019 and 2023. On average, the first sharp drop shows up within 3 weeks. But in a really hot market, it can take up to 2 months. Here's the key. That drop is usually a reset. It's just a reset. History shows it takes about 50 to 80 days or so after that shakeout for Bitcoin to break out to new all-time highs. If the cycle keeps following the script, we could see price discovery as soon as July or August. And that is when it passes new all-time highs again. So how do you actually use this? First, expect some volatility. A quick 10% pullback after a golden cross is normal, not a reason to panic. That's the market shaking out late buyers and setting up for the next move. Personally, I'm laddering bids and DCAing into orders near those moving averages, $102,000 to $104,000. I haven't made a post on this on X like just yesterday, the day before as well. I said about the $103,700 mark, whatever. I said, this feels like a pretty good time to start layering in. Second, don't just follow headlines, follow confirmation. As long as Bitcoin stays above the 200-day moving average, the tailwind is intact. If we close below 95,000 on the daily chart, that's a sign the pattern might be breaking down. And at that time, I'll reassess. And finally, watch the macro calendar. June CPI data is released on the 12th, and the next Fed meeting is on the 18th. We definitely want to watch those closely. These are the kind of events that can accelerate a shakeout or set the stage for the next rally. Bottom line, the golden cross is still in play. If we get to that 10 to 15% dip, consider it normal because it's exactly what the market has done every time before new highs. Patience pays, especially if you're letting technicals and cycle timing guide your plan. Also, on that short video I made on X, I also said if Bitcoin falls 10 to 15%, alts, your favorite alts, are likely to fall 20 to 40%. Maybe you want to consider laddering into those as well. Big picture, guys, the world is on the move. Russia and Ukraine keep raising energy stakes. Every time Russian missiles hit Odessa or Black Sea ports, Brent crude has spiked back toward $85 a barrel, keeping fuel traders on the edge across Europe. The IMF just told Pakistan to rethink its plan to plug in 300 megawatts of renewable Bitcoin energy for mining, enough electricity to light a mid-sized city, echoing the pushback El Salvador faced when it made BTC legal tender. They're afraid, guys. China claims it's sitting on a monster gold deposit in Hunan, yet physical gold just printed an all-time high of near $3,500 an ounce in April. To put that move in context, gold is up nearly 75% since January 2024 and another 29% just this year, smashing its usual pattern for a slowing economy. Central banks aren't waiting around either. They've already added roughly 228 tons of gold this year and are on pace to exceed 1,000 tons of net buying for the third year in a row, something we've never seen in modern history. But now, bonds aren't the only game in town for big US money. After the Bitcoin ETF approval, institutional inflows have gone parabolic. US spot Bitcoin ETF now holds around 1.21 million Bitcoin. That's roughly 5.8% of all the Bitcoin that will ever exist. Put together, those numbers say global capital is looking for new homes, new risk, and a new safe haven. In times like these, a flight to safety means more than just piling into treasuries or cash. For a growing slice of investors, like you guys, it means assets that can't be printed at will, whether that's physical gold or digital gold, like Bitcoin, with a hard-coded supply cap, just 21 million. And remember, those are going quickly. So how do you actually win in a market that swings from panic to euphoria and panic again, back and forth and back and forth? You stay ahead by focusing on what actually matters. Real activity, smart positioning, and seeing through the noise. That's how you catch big moves before the crowd even notices. Because if you take one thing from today's show, it's this. These times are supposed to feel hard. Uncertainty, noise, the occasional red day. These are preconditions for real opportunity. And here's the proof. Over the past 5 years, a single $1,000 investment in Bitcoin outperformed nearly every asset class on the planet. The old rules, they're gone. The biggest wealth shifts always happen in the fog of uncertainty when most people are too afraid to act. If you're here, you're already ahead of the next move. The flood is only beginning. Drop a comment down below, guys. Let me know what you thought of the video today. Let me know what you want to see more of. Destroy the like button. It would mean the world to me. Subscribe to the channel if you're not already. Share it with your friends. And be ready for our next high stakes update. We're building the new game together. And remember, stay humble, stay patient, and above all, keep stacking those Satoshis. I'll see you guys in the next one. Bye-bye.